Okay, so now we're going to take one more look at a bigger part of accounts receivable, and that is how do we deal with the customers that actually don't pay. So basically, we need to make sure accounts receivable is listed at an amount that's representationally faithful. All right, so let's take a look at how we deal with this. So GAAP requires that accounts receivable be listed on the balance sheet at net realizable value. Okay, you are allowed to do it at the gross amount, the full amount, only if it's not material, but in general, GAAP requires net realizable value. If you remember, net realizable value was one of the 5 ways that you can measure something. This goes back to conceptual framework. Historical cost was one, net realizable value, present value, future cash flows, etc. So net realizable value, also called NRV, basically allows us to, we estimate the amount that we're not expected to collect. We don't know exactly how much that's going to be, but we estimate it. And then we go ahead and with that, we record a bad debt expense. So the method we call this is the allowance method. And so basically what this looks like is just take a look here. Accounts receivable is listed at its gross amount. The amount that's estimated that's not going to be collected is shown here. This is a contra asset. It's an allowance for uncollectible accounts. And we show it as it ends up being a credit 100. Okay, so it's going to reduce our accounts receivable. The NRV is 900. On the face of a balance sheet, you're going to most likely see net accounts receivable, and then in the footnotes you will see more detail about the actual accounts receivable. Okay, so now let's look at an example from your homework. Okay, this first method of recording using the allowance method is called the aging of accounts receivable method. This is the most precise of all 3 potential methods, and you probably have done something like this in a prior course. So basically, one of your homework problems, you're given information, and you can pull this out from your accounting information system, right? You have a list of all your customers, and you can figure out how much they owe and what time period it is. So looking at Campbell Consultants, they have $85,000 that they owe us for current period sales. They're not late at all, but the past due ones, 1 to 30 days, is 32,000, and then they're about a little bit later than that on a couple thousand. Let's take a look here at Dapper Industries. They don't have any current or recently outdated, but look at here. 61 to 90 days, they owe us over $30,000, and this 11,500 over 90 days. So as we get to this later column, it becomes less likely that we're going to receive this money. Why are they taking so long? Maybe they're having a lot of cash problems themselves. So it makes more sense that we say, these ones over here we're less likely to get. And so the way we deal with this with the aging of accounts receivable is we go ahead and we have the percentages adjusted based on how far out they are. Over 90 days, we think 45% of those are not going to be collected. So the aging of accounts receivable basically lines up all the totals for each of the those little buckets of how late they are or current, and then multiplies them by the correct percent. And so we multiply that out and we sum across and we get a total. The allowance, we basically, at looking at all these accounts receivable, we think it's most likely that we're 147,510 is what we're not going to collect. We don't know which customers. Well, we know Dapper might be one of them, but we can't write them off yet because we don't have evidence to suggest that they're not going to pay. We have a little bit, but this allowance helps us. So basically we're setting up a cushion for these customers that won't pay. So we're acknowledging that we're not going to get the money, but we're not writing off their customer account yet. And when we finally have evidence that a certain customer is not going to pay, then we do an actual write-off. Okay? So here we have what they're telling us is that they give us the net credit sales for this company. They give us a couple other things, and I'm going to click on this to see our T accounts. So the ending balance of accounts receivable is 529. The allowance has a credit balance of 126,000. And what we can look at this is that this is what's left over. We didn't use up this allowance. We recorded it last year. We wrote off a bunch of accounts, and there's still 126,000 in it. So the allowance for uncollectible accounts is a contra asset, and it normally has a credit balance. So right now it's at 126. We need it to go to 147,510. Okay, so we don't want to add 147,510 to it because we already got some in it. So what we're going to do is add the difference. So 147,510 minus the amount that's already in it, and we'll go ahead and record bad debt expense. So this is an adjusting journal entry, last day of the period, and we go ahead and do that credit for 21,510. This accomplishes two things, as adjusting journal entries do. We get the bad debt expense in the proper period, so we're matching it with the revenues we earned this particular year, and the allowance gets at the correct amount so that it makes our asset, account receivable, show up at the right amount. Okay, so we go ahead and record that, and everything's ready to go. What we're going to do is say, what if we went ahead and that allowance account had a 7700 debit balance. And what that means is that we wrote off more accounts than we expected to. And we weren't off by that much. 7,700 is not too much. But if you think about it, we have a debit balance of 7700. We need a credit balance of this amount. So what we're going to have to do is add that debit balance 7700 to 147,510. And by doing so, that allowance account will end up at the correct amount, which is 147,510. And at the same time, bad debt expense is then recorded. So bad debt expense in this case ends up being a little higher than the amount needed in allowance. But that's okay, because you know what? We estimated wrong this period, and we were off by 7,700. And yeah, if we had done things really well, that should have been in last year's income statement, not this year's. But it's an estimate. It's not going to be perfect. And so, it's better that we estimate even if we get it a little bit off. Now, if you're thinking, like good accounting students, you're like, wow. So that means in the first example, they had, what was it left over that they had? 126,000. Well, maybe last year's, maybe they didn't do a good job. But you know what? Maybe they had a lot of those 45 to 90 day customers that just ended up coming into some money and they paid them off. You just don't know. When you have a large, whether it's a debit or credit, at the end of the year for the allowance account, you're going to think twice and say, okay, do I need to adjust my expectations? For example, do I need to adjust these based on past history? Based on past history. Okay, so that's what we're going to do there. And so we get through to part C. And so now they're asking us, how does this show up on the balance sheet? And so we have the accounts receivable, we had that balance 529, and we subtract out 147,510. Remember, it's the same no matter whether we did B or C. And so that's the NRV of AR, and that's what's going to show up on the balance sheet.